Buying your first home can feel exciting until the numbers start getting real. How much house can you actually afford? Are you locking in the right mortgage or setting yourself up for years of stress? The truth is, most first-time buyers make the same costly mistakes before they even get the keys. In this video, I'll walk you through 5 smart moves to prepare your finances, choose the right loan, and avoid surprises so you can buy your first home with confidence, not regret. Get pre-approved for a mortgage before you start house hunting. This step gives you a clear, lender-verified budget and shows sellers that you are a serious buyer. When a lender pre-approves you, they review your credit score, income, debt-to-income ratio, and assets to estimate how much they are willing to lend and at what interest rate. For example, if you earn $80,000 per year and have minimal debt, a lender might pre-approve you for a $300,000 loan at a 6.5% interest rate, which translates to roughly $1,900 per month in principal and interest before taxes and insurance. Without pre-approval, you risk falling in love with a $350,000 home that is outside your actual budget, wasting time and emotional energy. Pre-approval also helps you move quickly in competitive markets, where sellers often choose buyers who already have financing lined up. Keep in mind that pre-approval is different from pre-qualification. Pre-approval is more thorough and carries more weight. Also, avoid making major financial changes during this time, like opening new credit cards or financing a car, because that can affect your approval terms. The actionable step is to gather your recent pay stubs, tax returns, and bank statements. Then shop around with at least 3 lenders to compare interest rates, closing costs, and loan options before committing. Build a realistic budget that includes all home ownership costs, not just the mortgage. Many first-time buyers focus only on the monthly principal and interest payment, but the true cost of owning a home is much higher. In addition to your mortgage, you need to factor in property taxes, homeowners insurance, private mortgage insurance if your down payment is under 20%, utilities, maintenance, and potential HOA fees. For example, a $250,000 home might come with a $1,600 monthly mortgage payment, but when you add $300 in property taxes, $150 in insurance, $200 in utilities, and a conservative $200 per month for maintenance, your actual monthly cost rises to $2,450. That difference can strain your finances if you are not prepared. A good rule of thumb is to keep your total housing costs below 28% to 30% of your gross monthly income. Also consider upfront costs like closing costs, which typically range from 2% to 5% of the home price, meaning $5,000 to $12,500 on a $250,000 home. From a tax perspective, mortgage interest and property taxes may be deductible if you itemize, but not everyone benefits from that after standard deduction changes. The actionable step is to create a detailed monthly budget and stress test it by simulating higher expenses, ensuring you still have room for savings and emergencies. Save for a strong down payment while preserving an emergency fund. While many loan programs allow down payments as low as 3% to 5%, putting down more can significantly reduce your monthly payment and eliminate private mortgage insurance, which can cost 0.5% to 1% of your loan amount annually. For example, on a $300,000 home, a 5% down payment is $15,000, but you will likely pay PMI of around $150 to $250 per month. Increasing your down payment to 20%, or $60,000, removes PMI and lowers your loan balance, saving you tens of thousands in interest over time. However, you should not drain your savings entirely to reach that number. Owning a home comes with unexpected costs, such as a $5,000 roof repair or a $2,000 HVAC replacement. Ideally, you want to keep at least 3 to 6 months of living expenses in an emergency fund after closing. Also consider where your down payment funds are coming from. Large deposits in your bank account may require documentation for lenders to verify they are not undisclosed loans. The actionable step is to set a target down payment percentage, automate monthly savings into a dedicated account, and ensure you maintain a separate, fully funded emergency reserve. Shop multiple lenders to compare interest rates, loan terms, and fees. Even a small difference in interest rates can have a major impact on the total cost of your loan. For instance, on a $300,000 mortgage, a 6.5% interest rate results in a monthly payment of about $1,896, while a 6% rate lowers it to around $1,799, saving nearly $100 per month and over $35,000 across a 30-year term. Beyond the interest rate, you also need to compare closing costs, which include lender fees, appraisal costs, title insurance, and points, which are upfront fees paid to reduce your interest rate. Some lenders may offer a lower rate but charge higher fees, so you need to evaluate the annual percentage rate, or APR, which reflects the true cost of borrowing. Credit unions, online lenders, and traditional banks may all offer different terms, so it pays to get at least 3 quotes within a short window to minimize the impact on your credit score. Also ask about loan types, such as fixed rate versus adjustable rate mortgages, and government-backed options like FHA or VA loans if you qualify. The actionable step is to request loan estimates from multiple lenders and compare them side by side, focusing on both monthly payments and long-term costs before making a decision. Hire a qualified home inspector and review all contingencies before closing. A home purchase is one of the largest financial decisions you will make, and skipping proper due diligence can lead to expensive surprises. A professional home inspection, which typically costs $300 to $600, can uncover issues like structural damage, outdated electrical systems, plumbing problems, or roof deterioration. For example, discovering that a roof needs replacement could mean a $10,000 to $15,000 expense shortly after moving in. Inspection results can also be used to negotiate repairs or a price reduction with the seller. In addition to the inspection, your purchase contract should include contingencies such as financing, appraisal, and inspection contingencies, which protect you if something goes wrong. For instance, if the home appraises for less than the purchase price, an appraisal contingency allows you to renegotiate or walk away without losing your earnest money deposit. Skipping these protections to make your offer more competitive can expose you to significant financial risk. The actionable step is to attend the inspection in person if possible, ask questions about any findings, and carefully review all contract terms with your real estate agent or attorney before proceeding to closing.